All right, well, welcome everyone to today's session of Quantitative Brainstorm. Today we'll be discussing portfolio construction of systems. As always, I'll start with the disclaimer while everyone is coming in. Disclaimer, this is not financial advice, only my own and other speakers' personal opinions. This is not to encourage nor promote taking any trades, positions, or investments of any kind. Any information contained in this conversation is for informational purposes only and to take in as is. Derek Wong and other speakers have done their best to ensure accurate information. Regardless of anything to the contrary, nothing available in this conversation should be understood to be as a recommendation. Consult a licensed financial professional in your jurisdiction. Okay, I actually think today's topic is really interesting, and I think one that's fundamental to a lot of the work that we do as quantitative traders, systematic traders. And so I have a couple of topics listed out, some referring to the previous session. So one is the ideas of correlation and dependence. I did kind of tweet out my thoughts from last week, which kind of gives like a framework on how I think about things. The other one is my idea that a system applied to an asset transforms it into a synthetic assets return stream. The ensemble approach, parameters on strategy, strategies on assets, and then synthetic assets in portfolios. And I think some other important things that we all must consider are both adding new systems and looking at their contribution, as well as cutting bad systems, or what do you do with the underperformers. I'll kick it to the group now, and we can pick one of those topics to start off with.
Okay, I'd like to talk about the first topic you listed, correlation and dependence. This is a hard question for me. I find it really hard to map what correlation is like, to map what really matters about correlation. If we care about the linear dependence of variables as is measured by correlation, is it of any use at all? I find it hard to find any use of it. And that connects to the second topic you suggested, that we should look at the new return stream that comes from the system being applied to the asset return. And even in this case, for me, it's pretty clear that we should look at correlation or dependence of this new return stream when we are thinking about our portfolios. But even in this case, I find it hard to get a grasp of what dependence is when I use correlation. And I'll be glad to know, to learn from you guys if you use any different measure other than simple linear correlation.
G'day, Bruno. Hi, everyone. Look, I find system diversification very useful as a more static way to break correlations. So if we could imagine where we're in a position where we applied a single trend following system to a particular market, when you, let's assume we're applying one lot per position to that particular single system. So I find it beneficial to then trade an ensemble of, say, 10 systems, 10 trend following systems, each configured differently at 1/10 the position size. So what that effectively does is, through system diversification, you are reducing you're producing a better risk-adjusted return because you're trading an ensemble approach to a particular market as opposed to a singular approach. So in this instance, when we design our trend following systems to have different entries, different exits, different stops, well, when I say different exits, let's assume each system applies a simple principle of a single entry, a single stop, and a single trailing stop. provided those 10 systems all have differently configured entries, stops, and trailing stops, you introduce co-integration into your process as opposed to correlation. So co-integration is a more certain way of reducing levels of correlation than what we understand with typical correlation. So when, for instance, I trade different markets they might be positively correlated at some stages, uncorrelated at other stages, or even express sort of anti-correlation during particular regimes. System diversification through principles of more co-integration enforce a more rigid degree of low correlation into my approach. So that's one of the big benefits I see to system diversification. I hope that makes sense.
Yeah, sure. Okay, perhaps I haven't been as clear as I would like to. When I say that I find it hard to measure correlation and get a grasp of it, I mean that I find it hard to understand how it changes in time, and it connects to Derek's tweet when he says that if we use the correlation of the full sample when we design our system, we are implicitly assuming that it's going to be constant over the future. My question here is, I think that this is actually the best we can get. Assume that this correlation is going to stay roughly the same, over the future, and I can't manage to develop a system that's swift enough, that's nimble enough to change when the correlations or co-integration or anyway the dependence measure you prefer, when they change through time. Yeah, that's it.
Yeah,
But yeah,
look,
I get you, Richard. Co-integration seems to be a superior metric than co-integration, than
Look,
correlation.
I've got another thought as well. So I don't use a single correlation statistic to compile my portfolios per system. So when we adopt, say, the Pearson correlation coefficient, a single statistic basically describes the level of correlation between series 1 and series 2, and this might be over a 20-year time period. That single statistic doesn't give me the necessary information to know how the correlation does change over the course of time. So what I use is a visual approach of mapping the return streams for the entire time series together. So if you could imagine a single equity curve of a system being like a spaghetti strand, what I do with my methods of compilation is that I am bringing together lots of different spaghetti, each with correlations that vary over their time series. And when you map them together, you see that there are particular regimes where they might become all positively correlated, certain other regimes where they become uncorrelated, etc. Now, that's much more useful to me for trend following purposes to diversify my portfolio by recognizing that correlations rarely stay static, they do change over time, but noticing at what times or what regimes they tend to operate in a positively correlated manner. That way, I can assess the impact of a consolidated ensemble of return streams, where that maximum drawdown is, how they're offsetting each other. So the visual mapping process is a way that I get far more information than simply the application of a single statistic.
Hi to everyone. I want to say that for me personally, the best measure of correlation is of portfolio construction is a common sense. So of course we don't know how it can change, but we can use the probability theory maybe, because I think if we are talking about correlation, I think there always will be low correlation between oil, for example, and orange juice. So we must construct our portfolio in such way that there must be return streams that are much more uncorrelated as it can be, especially if we have not much money. We must choose it, and I have told this. So I think, first of all, we must use a lot of different commodities. I like these instruments, and I liked it because of Niels and Jerry and Moritz, and I'm very thankful for this. And I think the commodities here is a big key to construction of our portfolio. Because if we talk about financials, and Niels said this a lot of times, financials are very high correlated to each other, especially when it's a crisis.
Okay, I mean, I think that there's a lot to chew on with the comments that have been made. There are, I think, better relationships than correlation. I do think that this is a place where I know his name has been brought up before. Marco Lopez de Prado has done some work in machine learning to reduce the errors in correlation estimations. And that's just because of when you have to invert the covariance matrix, any error becomes more exponential. And that is something that we see an effect in a standard correlation estimation that can be removed using modern statistical techniques. And I will put this kind of ML stuff in a modern statistical technique. And that helps reduce some of the noise that you will see in these types of estimations. So modern math has given us abilities to do it better than the classic Pearson coefficient. There are other methodologies as well that I've experimented with, some using graph theory and looking at the network clustering as well. But it all comes down to what are you trying to do with the dependence, and what exactly is the dependence you're measuring. So getting back to the basic fundamental issue is, why are you measuring this relationship, and what impact is that going to have at the end? If you're measuring them across all of these assets and deciding in a portfolio, maybe you would prefer a clustering method because these ones have some relation. If you're looking between systems that have different parameter sets, maybe you would prefer a network approach, or you can do the hierarchical risk parity method, which is proposed by Marco Lopez de Prado, and it will help you deal with those types of things, but still with a better way to kind of get rid of some of the errors, as we think in the covariance matrix. Talking about co-integration, I'm not sure I'm understanding what Richard is saying, because every time I've used co-integration, it's to find mean reverting properties. And normally it's like, say you do a Johansson test, Engel, Granger two-step, and you're trying to find if there's one or more co-integrated relationships. Maybe you're looking for like a one related eigenvector or something, and that it will, over the long term, which is something that co-integration doesn't have, will come back to this relationship. So if you look at stat arb, it's used a lot in that area, but I can't see how co-integration is going to help you find diversification, because normally these statistical tests are just saying yes or no, as like you get the p-value or not. So either they are mean reverting, or they're not, or they're non-stationary and have an order of integration 1 or something, or some linear combination or something like that. So I'm not sure I totally understand how that's used.
Okay, so I'll explain it this way. So a perfectly hedged trade is a co-integrated trade where we're one position long, we're one position short. The relationship stays static over the entire time frame. So that's an extreme form of co-integration. So what I'm referring to, with this use of system design, we can design our ensemble of strategies so that when one strategy is active, another strategy might be blocked. Or when a trend is turning, we might have a strategy that is trending in the trending direction, and another strategy which is configured to operate within a smaller timescale will catch the downturning trend. Now, These are methods of design which force a degree of co-integration into the different return streams of each of those systems. So it's not correlation, because correlation tends to wander. It's more co-integration, because you're forcing this arrangement into your ensemble of systems. So, if we've got a trend following strategy that might only have a win rate of 20%, trades, a very long-term perspective, 2 to 3 years, we can bundle up different trend following systems of different time frames, different win rates, different trade frequencies, to break the natural correlation that might exist in a single trend following system. So that's what I'm meaning in relation to the use of more a design imposed constraint, a bit like trading options, which is forcing co-integration or as a tail risk component into strategies. That's what I'm referring to when I'm talking about co-integration.
But if you were to have this perfectly hedged portfolio where you have everything offsetting each other, wouldn't you just net zero? I mean,
Yes,
and if
that's right, Derek. I'm not. That's the perfect hedge, but there are degrees, like not full static relationships, but you can constrain the relationship through your design parameter set. So you can find, for instance, when you've got trend following systems that have a 20% win rate, a 5-to-1 reward to risk, you can find alternate trend following systems with a 40% win rate and 3-to-1 reward to risk relationship that provides a degree of offset. So they both have positive expectancy. So unlike a hedge trade where the long and the short component neutralize each other, there is a degree of positive expectancy in all of your system return streams over time. They just trigger at different times across the time series, and their designs basically specify when they're active and when they're not.
I think that, first of all, by my opinion, we must avoid such situation as much as we possible can, of course, when all goes to one, as we have seen in all crises. Stocks, bonds, in crisis 2020, we saw unexpected situation when most of the instruments went to zero. And in that situation, and Niels talked about this, commodities, I'm talking this again, was in a good shape. So my position is the same, that we must have good commodities base, good commodities, strong commodities in our portfolio, and that will help in crisis situations. And if we maybe, of course, it's very good to have different time frame, system diversification, in fact. But the main diversification for me is diversification between asset classes, and it must be true diversification. So I don't trust here much to financials, to bonds, to equities, and to currencies. That's my opinion. Of course, it must be, of course, in our portfolio, but we must understand that it will go to zero with a very high probability, and always go to zero, if we will see a massive crisis.
Richard, I'm a bit confused as well about this co-integration idea, because, I must admit I haven't played a lot with it, because, as Derek said, it seems to apply more to convergent strategies than divergent. So, startup and things like that. But my understanding of any co-integrating strategy is that which tool you use spews out a vector. Effectively, you're changing the basis, as you were saying. You come up with all these orthogonal bases which are different, and you build your portfolio. But how can you do that in your frame of the world where every trade commands the same amount of allocation? So I don't understand how you can reconcile vectors. They all say 1 1 1 1 1. Yeah, they point in different directions, but you're just going maximally right and maximally left. And as Derek said, you're left with a zero. And so that's one element of confusion. The other thing I wanted to highlight, perhaps to Bruno, is exactly as you said. I mean, there's this conundrum when you look at correlation in terms of traditional estimates. How do you make it sensitive to time, as well as stable. It's obviously a big trade-off. Ideas that people use are exponential smoothing. It's definitely better than this one static correlation. Obviously, you need to pick your windows and things like that. But the other thing that Derek said, thinking about hierarchical, so going from geometry to hierarchies, and risk parity comes, HRP, hierarchical risk parity, comes into mind. But perhaps the best idea, which got me very excited, and Derek again brought up the other week, of using graphs. So in that world, you just describe your individual position, strategy, whatever, as edges connected by by lines, and so you just have a pictorial representation of your portfolio. And you can look at different things. How and again, Derek should hopefully give us a bit more of an idea. But what he was saying, or at least my recollection, is that you can estimate the strength of those edges, and so do one thing, and so do the sort of the numerical way, but also what Richard was saying, the graphical and pictorial way, and just looking how edges sort of keep connecting and disconnecting between different nodes, and then things become more or less correlated, and then draw conclusions from there, especially in terms of regime switches and regime detection and phase detection and this kind of thing. So it can be very useful to migrate to this new framework that just looks at graphs rather than just having a geometrical representation of things.
What I'm meaning about that co-integration is that the way I view co-integration is a more direct causal relationship between the moving variables. So where you've got two different markets that move along in a time series, and you're comparing the two, that's a correlated relationship. But what I'm talking about with co-integration is where an example is the drunk man's walk, where you've got the lead, the man walking the dog. When they're both walking together without a lead, there is a correlated relationship between them. If the dog stays close to the man, the dog might run off to a tree, go another place or whatever, and they might become uncorrelated at that particular point in time. But when you attach a lead, a structural causal relationship between those two variables, you create a more static moving relationship between the two. Now, yes, they do mean revert over time, but that's not why I'm using co-integration. So if you could imagine trading a single market, if, for instance, you elect to diversify just across markets, let's say you've got 40 markets, and you're applying a single trend following strategy to each market, then you are forced under this diversification principle to look at the correlation between markets. That's your only way you can achieve a better risk-adjusted return. However, when you use an ensemble of different systems, different trend-following systems with different entries, different initial stops and different trailing stops, when you trade an ensemble within a single market, you can get a better risk-adjusted return within that single market. So it's really just looking at the return streams generated from each of those different systems, trend-following systems for that single market. You treat that as a sub-portfolio. So when you compile those different systems together, you can use principles of design, because that's the only difference between your trend-following systems that you're applying to that single market. Apply principles of design to lock in more static relationships between how those return streams all move together for that single market, which means that you're adding another layer of uncorrelated relationships through design principles into your portfolio, which is where you can achieve significant bang for buck in terms of risk-adjusted returns when you're looking at both diversification across markets and diversification across systems. The diversification across systems, the only reason they differ in their return stream profile is because of the design principles or the co-integration, as opposed to the correlation, which can be a moving feast, and the correlation does not necessarily imply causation. But through design principles, we can lock in a causative reason for why those return streams may co-vary together?
I want to say that, of course, diversification across systems, across time frames, and accidentals, in fact, it's a very important thing, and I had a lot of research here. And of course, we can see even in a flattish period, we can see that in 1 hour system number one, we say, it's -1, and system number 2, it's no trades, so we keep our money, save our money, and so it's even in a flattish period, if we have no trend, it's good. But I want to say that if we have not enough money for diversification on our account, I think we here see a choice. Will see a choice. Must make a decision what to do, and here is to have a massive diversification across different markets, or to have less markets and have a diversification across systems. And here I think that it's much better to have diversification across different asset classes. I'm sure it's so. So if we have a choice, if we have not so much money as we want to have in our account to be a proper risk management rules to do it okay, I think we must choose diversification across the different sectors. And if it's all okay with account, we have enough money, of course it's very important to have diversification across systems and across different sectors. But first of all, diversification across sectors, I think so, if we have such a choice.
I do think that well, I think we can move on to the next topic. We've kind of gone into it a bit with these comments. Oh, hang on, Andreas, I will invite you to the stage. The idea of this dependence, I will call it. I'm not going to call it correlation, because what I feel, or what I'm trying to understand from Richard, is he's designing systems that will trigger at different times to try to offset each other. Maybe it's not as I understand the mathematical properties of co-integration, but I understand the design principle behind. And then that goes into kind of creating a portfolio of systems. And one of the examples that was brought up was, what if you had one system applied to many different markets, and looking at that portfolio versus having a portfolio of many systems on many markets. And that's just, I think, compounded diversification in my mind. I don't think it has really anything to do with much else. The idea that these one system to multiple systems, of course, is a bump, but there's a difference between those two steps. And what I mean is, once you have applied the system to an underlying, it is no longer that underlying, and that correlation or whatever dependence, we can just get out of this correlation argument. Whatever dependence measure you were using, or what to construct your portfolio, you can use any metric you want, is now different. So whatever intuition or whatever measurement you had when you just selected the assets, and then you've transformed them into something else, what I call the synthetic asset, because you're applying some action to it and turning it into something else. Now we'll have some kind of different dependence. And I think that's very important. Normally, what happens is you could decrease that dependence or decrease your correlation. I guess we'll just stick to the correlation for nomenclature to keep everyone familiar with what we're talking about. But the idea that you're now dealing with something different, I think, is very important. And then now you've got these different things that you're building blocks on top of. It's not actually the first building block.
Yeah, I think it's this idea is of fundamental importance to look at the dependence of the asset returns through the lens of your system, whatever it is, of this synthetic asset as you're calling it, Derek. I think this is of fundamental importance. And then back to my results and my experience. however short it is, I feel that when I apply my trend following systems to the assets I look, their correlation over time, over the full sample, over selected windows, of rolling windows, it decreases. And that's why I get more confident or more relaxed to not take that much care when selecting assets. I agree with a comment by Oleg that we should look at the sectors and in a heuristic way try to build our portfolio of assets that we look, not of systems. So that's a different question, but of assets. But even then, it gets tricky at the edges because sometimes things look similar or feel similar, but they're not actually similar, or they're not actually the same sector, or perhaps there's an asset could belong to two different sectors. I don't know, just an example here. Norwegian krone could be viewed as a currency, but it also tracks really close the action of oil. So it has some dependence on the energy sector too. Then how do you balance these things to build your portfolio? That's not trivial. It's not as easy as okay, select a bunch of currencies, a bunch of energies, a bunch of whatever you want. Okay, I'm just rambling now. Sorry.
I think in a situation that if we don't have enough money, we must do as much as possible as we can. If we have enough money, we do the same as much possible as we can, as much possible markets as we can. I think so. And I think here is a key here.
I don't
So
think logic is enough. I think you've got to test it. You've got to use. So this is where backtesting is useful. I know we always pan the use of backtesting, but that is more in relation to the fact that we don't use backtesting as a way to forecast future returns in any shape or form. But we do use backtesting to stress test our portfolios. So Bruno, you said that you don't know how to compile these portfolios using logic alone. I totally agree with you because logic is not a very useful weapon when trying to assess whether or not markets or systems are correlated together. You've got to use the long-term data sets to actually satisfy that assumption you've made in your logic. If you don't, you'll find that, and this is for instance why I trade Brent and crude together. Whilst a lot of people say, "Oh, they're very correlated," my research and my backtests over many years conclude that there is sufficient degrees of uncorrelated relationships in these two markets that I can safely trade them. There will be periods of time where they become positively correlated, but there are many other periods of time where they become uncorrelated. So just the assumption that you should stretch across different asset classes is not enough for me. You've got to validate that hypothesis with your testing.
yes, and I just wanted to add to what Richard was saying earlier, which is so yes, I've tried to do that same thing where you have like I'll have my longer term systems, which I really like and love, and they have the highest expectation of the best performance. But in order to get some meaningful diversification, for instance, when Moderna is crashing and my long term systems are staying long, I need a short system, a shorter term system to get short in that situation to hopefully add some diversification. Now, the ATR when I go short, that shorter term system is going to be much higher, and so my position will be 1 unit short and 1 unit long. But actually, I'll have much fewer shares short Moderna on the short term system, but which is a minor thing. But the problem is that The further I get away from the systems I really like, which are the long-term, medium-term systems, and try to get closer to shorter-term systems that are going to add meaningful diversification, the profitability goes a lot lower. So I'm faced with this idea that if you want more diversification in your system choices, well, to some degree, at least for me, mortal Jerry, one entry, one exit, one stop loss, trend following. The shorter term I go to get more meaningful diversification from a system point of view, the worse the worse the systems are going to become. They're not overall very profitable.
Yeah, but you say that the profitability goes down, and I agree with you. When we talk about the individual system, um, I agree with this phrase that the longer term systems are more profitable. Okay, but when we look at the whole portfolio, doesn't it make sense to add these less profitable systems that are profitable in themselves, but not as much profitable as the longer term? But as they protect our capital, then as Richard always reminds us, compounding can work better. We attenuate the drawdown of the portfolio, and thereby improve the performance of the whole portfolio. Do you find that the whole portfolio profitability goes down when you add this shorter term systems, or just talking about the system in itself?
Both. So I do find that you're saying to yourself, okay, I'm going to make less money with the shorter term systems, but if I pay attention to sharp and drawdown numbers, then maybe it'll be it'll be a good addition. But I haven't found that to be true. So yeah, so that's the whole problem is that I was taught to go find systems that maybe lose money, but that will improve your overall performance. But I never was able to pull the trigger on that because just in doing the back test, there is this break even. It can be a little bit less profitable, but if it becomes too much less profitable, then you'll scratch this itch that you have today with this trade that you're like really not liking to lose a lot of open profit. But overall, it'll be a net loser and not help very much at all. So I never could really convince myself to choose to make less money. And then once again, as Niels and Richard talked about briefly, we've been in more depth on our clubhouses talking about trade level and the trade level calculation and when to change trade level, when to increase the trade level based upon profits, open profits or closed profits, or how I do it and how Richard does it. This is this does have an impact on compounding, but Richard wouldn't do it if the impact was very negative, right? So it's not. I don't think it doesn't carry the day in compounding, and so since I don't, I don't really increase my trade level based on open profits. I'm not getting any benefit, from today making more money today versus making more money over the long term.
And I want to
Get it?
say,
Thanks.
okay, I want to say that today I'm maybe a representative or ambassador of a. It's a joke, but of course it's so. And I want to say that what is for small manager the best decision, and I thought about this very much. It's very important to choose the best, because not too much choices. Small manager can diversificate, as I said today, across strategies and so on and so forth. So, what is the best choice? The best choice here is to trade what perform the best. So it's long-term systems, and we know that statistically, from 180 days to 250 days, it's statistically good, and probably with a very high probability, it will be good, and have a market diversification as much as we can. So it's the main important things to do this. And Other things, if even you have a lot of money, it's maybe in addition to system diversification and so on, so forth. It's addition. I said it before, but I think when you're small, it's very important to understand what is much important to survive in this game, to have profit in this game. And so if you will do something that is less important, it can ruin your account. So the most important thing is good risk management for all managers, of course. Small or big, no matter. Good risk management. Diversification as much as possible, and if you have not much choice, only long-term systems. I was a short-term manager. I know what it is. It's very good for training. For training, yes, it's good training, but because you see a lot of trades, how it works, you see this, and it's good. But in fact, I'm very thankful for Jerry and for Niels that they told in this program, my favorite program, Top Traders Unplugged, that is the best approach to be a long-term manager. And statistically, mathematically, it's the best approach. And to know it, it's a very big. It's a superpower to know this. This knowledge is a superpower, in fact, because when you look at records of short-term managers in short term. It maybe sounds funny. In short term, you can see very good track records of short-term managers, and you can see that even intraday managers and so on. But in fact, if we see long track records, good research, big data, we see this big sample size. I think we see that the better approach is to be long term. So if you don't have enough money, it must be long term only. I'm sure.
I'm going to throw a spanner in the works here because I actually think, Bruno, what you were saying, I agree with. I think the ultimate aim of our entire process is to produce the optimal uncompounded geometry that then allows compounding to do all of the heavy lifting. So let's have a look at why trend followers trade both long and short, and let's consider equities. Like if we use performance of our return streams as a basis to assess why we go long and shorts, we clearly would be long only, because over the historical track record of the last 30 years, shorts, they've managed to sort of be fairly profitable, slightly profitable, but they certainly haven't been super profitable like longs. But the reason you include shorts and longs is because the return streams of the shorts against the return streams of the longs provide correlation offsets. That produces this superior uncompounded geometry. So it's not because of we're not looking at strict performance over the long term. We're looking at the geometry of that return stream and so why don't we trade short term? Well, when you do your back tests, you see that geometry is actually negatively affected. We get non-linearity starting to be expressed in our unprofitable systems. We want to eliminate that non-linearity, that downside non-linearity. So that is what prohibits us from trading short term, because there is just too much noise and mean reversion in those signals. Yes, there are outliers, but by far the majority of your trades are whipsaws, which the noise and the mean reversion dilutes the asymmetry of the outliers you catch in that short-term environment. So that's why we stretch out to the medium term to long term. It's because the signal to noise is greater out there in relation to these things we call our outliers, which we focus all our attention on. We don't want to trade the everyday market churn, which produces linear, almost random sequences of results of -1 + 1, -1 + 1. We want to catch these massive outliers. And out in the medium to long term, we get that better geometry that therefore allows compounding to do all of the heavy lifting. So I think it's a question of geometry as opposed to performance at the portfolio level.
Yeah, thanks, Richard.
I think as well, when you think about the short-term part of things, as mentioned, obviously the signal to noise ratio or the noise there is pretty much higher. When it comes to the longer term it goes, these signals basically average out each other, and then you get a clearer path. So it's almost like, how do I say it? It's almost like you're in a, let's say in a farm, you have your weeds, and if you just look closely, then you only see the grass. You don't really see a pattern. But if you broaden your scope, you will notice that you're actually on a farmland, which stretches out for further part. So I think it's also about, I don't know exactly how to mention it, but it's also about, those signals basically averaging each other out, and then those small time frames, obviously, in a bigger time frame. The bigger time frame is part of, oh sorry, the smaller time frames obviously average each other out. In the bigger time frame, they're all catched up, so then it's easier to see the clearer path in there. So yeah, that was something I wanted to add on.
Yeah, Jeffrey, I liken it to trading on an ocean. If you, for instance, use an area of the ocean which is maybe 500 meters square, and you look at the wave dynamics in that small location, there are no outliers. There's just waves going up and down. There's a lot of noise. But as you expand your sample size to include the entire ocean, you get these periods where you get positive amplification of the wave function, and you get these things called rogue waves, and you get things called tsunamis, and you get these major massive events, all from the way these little waveforms basically can, in certain regimes under positive feedback, amplify. So that's why we step out to the longer term timeframes. We're looking at a broader ocean rather than focusing on a very sort of tight, sort of short area or short time span to search for our outliers.
Of course, I'm going to take the opposite position here. If you're trying to optimize the uncompounded returns for their geometry, I'm still not sure how I haven't been able to get in my head how that geometry works, but I'm just imagining stacks of like little trade wins, where you're not increasing the position size and everything is like one unit. The best trading strategy would be a mean reverting trading strategy, and something at the highest of time frames. You could think of high frequency trading, market making, things like that. And the reason is because they would be able to stack the maximum amount of little bricks as possible, as quickly as possible. And if they're uncompounded, because a market maker necessarily can only have so much inventory, or a market is only so liquid, they're constrained by how much capital they can deploy in a single market or whatever markets that they're looking at, which is, I mean, there's not so many public market makers. It would in fact cut off their tails. And that was something that Richard also mentioned, is that it cuts off your tails and then you're trying to compound this geometry. But in actuality, the person who's benefiting the most from this will be someone who's actually cutting off the tails and benefiting from the mean reversion, because they're not compounding. Their drawdowns will be smaller because they're not continually adding additional size, and so that would cut off their left tail and maximize the middle, where they're actually able to stack the most amount of these individual trades.
Yeah, I tend to disagree with that because I think mean reversion produces these many small linear wins, but occasionally when it goes pear-shaped on you get these non-linear sequential losses. And that non-linearity of that sequential losses starts forcing you towards the adverse tail region of the distribution of market returns. So when you actually stack upon stack upon stack mean reverting systems, and where you do find that because they can actually be correlated, you can get these massive non-linear adverse anomalies, significantly deteriorating that uncompounded geometry. So where trend following, I believe, produces this superior geometry is because when we catch these outliers, we get these non-linear step-ups, which are many orders of magnitude more than the linear sequential losses we incur through our drawdowns. And that geometry, there's an asymmetry there of positive beneficial asymmetry that under compounding produces a superior compounded return over the long term.
So I think the question there
I
is,
think. Oh, sorry.
no, I was going to say, because you have obviously the linearity, and then you have the tail events where it gets asymmetric. So then the question, if I think about it mathematically, is if the very simply said, if the profit loss from coming from, or the the gains coming from the linearity is bigger than the asymmetrical tail events, then that would be more beneficial. The mean reversion would be more beneficial, if I think about it clearly. But the problem is with asymmetrical, those tail events, those can easily stack up, or win over the linear events, and that's why I believe I agree with Richard in that sense, that the if you look at it from a overview or main point of view, you get the. I tend to agree with the trend following principle, that you have to chase the asymmetry instead of the linearity, because they can easily compound stack up.
And I think, I mean, Jeffrey, you hit it on the head. This is where I'm getting stuck. I don't accept that other part in this world of, um, say, these linear, non-compounded returns, exactly for what you said, because they would be additive. One trade plus another trade. You're not compounding. You don't multiply. So there's no ergodicity. You, by necessity, have removed the ergodicity, which is the problem with trading a mean reversion. So in this world of, you know, non or like say linear stacked returns that don't have the compounding, necessarily it must be better to trade mean reversion because you have cut off that asymmetric move. When you make the jump from going to that, we do have these nonlinear moves, you're assuming that the multiplying process occurs again, and then as a counter argument, but that doesn't exist in this world. So that's where I'm getting a bit stuck.
Yeah, and just not to add to the to contention, but there's also this view of correlation or dependency structure, which almost doesn't matter to portfolio construction. And so, it's really hard to see how, by not believing in compounding, as well as not believing in correlation as an emergent property of any portfolio, because it's following what Derek said. Once you apply certain things to trades, i.e., you put them through the transformation that each system gives, you have a different object. And composing these different objects, I was making the fruit basket, fruit salad analogy the other week. It's exactly that. So we're saying, we go from one thing to the other, but don't worry about correlation, because it doesn't matter. It just comes for free. You don't have to pay, or you don't have to optimize it. It just doesn't matter. And on the other side, you say, oh, I want to maximize my uncompounded geometry, and therefore sort of cutting off your own ability to exploit these nonlinear trends. It seems very difficult to reconcile, and by magic say, oh, but this is a superior way of looking at things.
No, what I mean
No,
when I
I
say
mean,
when I say maximize the uncompounded geometry, what I'm saying is that when we apply compounding on that asymmetrical uncompounded geometry, um, because it is positively skewed, because step ups are greater than sequential drawdowns, linear drawdowns, because of that asymmetry in that uncompounded curve, the compounding effect is greater. So if we took a linear line, and said that was an uncompounded geometry, that would produce a very good compounded return, that linear growth line or that linear equity curve. However, if we apply step-ups, non-linear step-ups, against linear drawdowns, we find that we actually get a beneficial positive exponential slope to that uncompounded geometry even before we compound it. So we get an extra kick from compounding when we naturally apply a compounding technique to that geometry. So that's what I'm saying, Bruno.
And all you're saying is that all the lifting is done by the market. You don't believe in anything. I think I understand your idea, but you're then saying don't do anything on top of it in order to create these non-linearities in your portfolio, because everything is hocus pocus. It doesn't matter. All you're doing is just destroying your ability to compound. But the market is going to do the heavy lifting for you. You just don't
Yes.
know when and how it's going to come.
Yeah, so what I'm doing is I'm saying, all right, I believe in what complex adaptive systems tell me. And what complex adaptive systems tell me is that change is ubiquitous and transitional change is greater than the change associated with the concept of equilibrium. So there are periods of time where complex adaptive systems appear stable. They appear to operate around an equilibrium. There is a predictive pattern associated with that, which mean reversion certainly does exploit to get these linear sequence of wins. However, during these transition events where things become unpredictable in complex adaptive systems, the change associated with that tends to be non-linear, massive change. And so it's relying on a scientific principle as opposed to a predictive stance. So that's why I say I'm not a predictor, I'm a price follower, because I've got confidence that these complex adaptive systems, which are our markets, will have this non-linearity as a natural feature of their mechanics.
Understood. Thank you. And all you're saying is that there's almost no point in trying to understand the structure of a portfolio, because then moves you into the realm of prediction, in as much as you are sort of making a determination or making an assumption that whatever structure you can measure and recover through all sorts of tools is going to, to stay in place and hold stable when it might not do so. Is that what you're saying?
No, I'm not actually saying that. What I'm saying is that from a profit perspective, from catching these outliers, there is nothing we can do about it. It is something the market gives you. However, from a risk management perspective, there is certainly something that a backtest or the market can give you. It can tell you the risk associated with a historic path. And over a very large data sample, that has meaning to me. That tells me how robust my strategy has been over a single historic path that might be over 30 years. In fact, because I apply this multi-market test with it, I then apply that same principle with my trend following systems across another 100 different markets. So my sample size is huge with 100 different possible historic paths to tell me how robust my portfolio is. It's just to stress test it. So I'm getting risk management information from my history, but I'm certainly not getting any information about when or where these outliers will deliver my profits. So it's all about risk management, which is why I do believe at a portfolio level, there's lots we can do with risk management. There's lots we can do with reducing our position size to very small bets. There's lots we can do with the structure of where we put our stops and initial stops. And at the portfolio level, there's a lot we can do with principles of co-integration and correlation across markets and return streams, which is why we prefer to use uncorrelated markets. So I'm agreeing with Derek on a lot of things and you on a lot of things, but there are certain things I just disagree in relation to future profits, effectively.
Yeah, thank you. I think the semantics really clarified it, because I was going to say that we agree on all of things. Just to make it absolutely clear, and perhaps it helps cleaning up this confusion, I am not predicting when I use continuous signals. I'm simply, if you follow from last week, I'm simply measuring and scoring my precision of the signals and drawing inference from that and saying, okay, if my signal is more precise, I can trust it more and I can adjust my positions. And on correlation and on risk management, I'm saying the object, this wonderfully convex object called a portfolio, allows me to do things that individual trades can't do. Much in the same way as Derek says, you're transforming your single trades into synthetic assets.
Totally understand, Bruno. But we all, in effect, in this clubhouse, we're all trend followers. But there are slight nuances, and my approach, and maybe Jerry's approach, and your approach, and Derek's approach, they may wander into different areas. But there is a hell of a lot of similarity between the approaches, and it's just something where we use different techniques to. Under our research, it's where our research sort of investigation goes towards always trying to sort of improve our models.
Yeah, I was waiting for this Kumbaya moment. I totally agree with you.
Maybe we're too biased still to the trend following. I mean, I think it's quite interesting though, but you know, I want to kind of push the next topic, and although we all have the trend following in our blood, still try to keep an open mind about other stuff. So I will go into something I think that every one of us, trend follow or not, needs to deal with, and that's adding new systems or cutting bad systems. And I have found with meetings with many other managers or other traders on how to do this, I find it extremely difficult problem for some people, especially doing it in a systematic way, in a rules based way. And I want to open the conversation with this, to see how do people do that or deal with this problem, because in the end that is like where the uh, rubber meets the road. Like all of this research, all of these ideas we're doing, if we don't have a good way to implement it in a way that will execute correctly is one thing, and then maybe if you're trading something else, or you have other strategies as well, not just trend following, they may go in and out of favor, or certain parameters will go in and out of favor. And how do you deal with that instead?
Yeah, very interesting, Derek. Look, I think you're all aware of what I do. So each year, I undertake this full-blown workflow process. Might take me about 2 or 3 weeks to totally replace all the systems within my portfolio. Those trades that are currently active on the prior year's systems, I let run their full course, but then I implement a totally new suite each year based on a 10-year look back, for ones that have passed this recency test of the last 10 years and also are robust over the last 30 years. So this constant replacement means that I never allow rules such as reaching a maximum drawdown as a signal to replace my systems. I'm continually replacing systems irrespective of their performance, each year using this rolling window. That way it enforces this disciplined rules-based workflow process into my method, which therefore makes me avoid having to deal with things such as when do you turn your systems off or when do you turn them on. They're just continually replaced. And I believe that is a way that I can, in these adaptive markets, I can progressively, slowly build in a level of adaptation into these systems through that technique.
Richard, when you put a new system, a new update, let's say, on, uh, suppose the system says you should already have a particular position. Do you put it on already, or do you wait for it to close, and then when you get a new entry signal, you would get in? I know this is particular to us that look at trade-based backtests and trade-based systems. It's not exactly the same with continuous guys like the other Bruno and Derek. But I find that, well, when I started trading trend following, I had a couple of signals already on, and it really hurt me because I got all the drawback, all the give back from some trades, and not that much from the upward move of an ending trend.
Yeah, no, look, it's a fairly simple process. So let's say that I've got 100 or 150 live trades at the end of a particular year. I let them play out. Some of them might have been running for the last 2-3 years because of the long-term nature of these trades. But I totally replace with new systems, and I take the very first signal that comes up on any of those new systems that I add. So I'm not waiting for um, um, a new sort of a signal of a trend. I, for instance, can get in straight away with a lot of my systems on a fairly mature trend when that new set is imposed into my portfolio. So I have tested both approaches. Yeah, look, I find that the simplest method is best. So I just do the overlay, let the existing trades play out, and just take the new trades when they pop up.
I
Okay, thanks.
will share my approach as well. It's similar to Richard's, I think. Um, I do have a dynamic allocation process that does use optimization, and what I'm looking at is performance and correlations, or we'll call it the dependence. I mean, we're not going to get into that semantics again. But the idea that I'm doing it on my synthetic assets, right? So you get that diversification benefit if you only had one. So, like in my findings, if you look at one system across, all of the assets, you probably will reduce the overall correlation by like zero 0.1 or 0.15. So you automatically get that benefit. And I'm also looking at making sure that when they combine, like there's multiple places that these things are being combined. You have when you have a large portfolio of many systems and many parameter sets for each system, you choose to look at each parameter set on each system, on each asset as a synthetic asset, or you can look at the ensemble of all parameters on one, and like, you can split it up many different ways, but at the end you continue to aggregate. So it's like a big funnel. And as you funnel down, you're able to identify, what's these dependency relationships and what are, parameters are meeting certain fitness functions, and you can trim down. And again, to reiterate what Richard is saying, that it creates a systematic way to trim bad systems, and it will also bring online systems that maybe weren't online, or increase allocation to those systems that might be becoming in favor. I know that if you think about, then the end product will be the sum of all of the signals combined on that asset return. And then going back to what Bruno said, yeah, the continuous versus not continuous question, I don't think is the problem. It's more about, like, are you delivering daily returns, or are you delivering trades? And it gets back to that kind of dichotomy. Um, I do believe whether you are doing trades or you're building a continuous portfolio of returns, if you're doing it in a professional setting and you have sold someone something, you must take the trades the day you open the fund, because those are the returns that they're expecting. And it's just unfortunate that the trades you put on went into drawdown or not, but the sum of the days become months, and those months quarters, and that is the product that they were delivered. So even when before I had discovered continuous signals, I was doing the discrete method, and I was doing that just because I felt that that was what the client was paying for.
And on your point about, how do you add new and bench strategies that need to be phased out, my approach is that if something has ever been good enough, so tested good, even if it's not delivering right now, so in my framework can have an allocation of 0 because of all the things that you guys know. But even then, I don't kick it out of the portfolio because it might come back into fashion. So think about last year when the world was coming to an end. Obviously, carry trades, all sort of carry or convergent trades, and I have some of those in the portfolio, were getting killed. So the system was cutting and cutting and cutting, and then for a while it just stayed out of it, and then eventually it kind of got back into it. So the optimization, or the portfolio allocation, risk management, however you want to call it, portfolio construction, has some sort of process whereby it looks at how things are delivering, but also how the overall composition of the portfolio, all those synthetic assets, are sort of stacking up together in order to maximize terminal returns. So the idea is, once you find something that works or has worked, to keep it in the portfolio and let the allocation and deallocation do its own work, its own magic.
I find, Bruno P, that me and you are on the same wavelength, because I have never removed a system that had gone through all of my back testing, robustness testing, small live trading, whatever. That once it's reached production level, it's there. And the allocation to that strategy may be zero, but I'm still tracking its performance, as the days go by. Because, like you said, especially when you have portfolios made up of multi-strategy, which it sounds like you do, and I also, um, when you're looking at different types of strategies, the diversification increases a lot. And that is where I think the analogy to trend following breaks down a bit, because you're still trying to find trends. So, like, what you're exploiting is the same. When you start to break out into like carry trades, dividend trades, volatility trades, maybe you're going after, different places on the curve, whatever, you would now have totally different risk premia you're exploiting, which have different properties, and then building systems on top of those and then putting those into your portfolio. Um, the entire factor itself that you're exploiting, or your risk premium you're exploiting, might come in and out of fashion, or not, but also you are able to scale the same framework that you've built, from the trend following or from the multi system, on one, kind of going after the same idea, uh, to create lots of things on lots of instruments that are doing different things. And I find that very interesting. And the second point is that, when it also takes the discretion out of it, when people say, oh, it's out of fashion, or trend following is dead, the classic, um, maybe short vol was sexy or something. Uh, that is not affected by us. And I do think there are some people, or we know during COVID, some people were overriding these things because they thought things didn't work, or large asset allocators were deciding, with human judgment or discretionary judgment, that these things should go out of fashion when in fact they didn't go out of fashion. So by taking the evidence-based approach and having a prepared portfolio, and by prepared, I mean you're able to exploit these things by having strategies pre-built that if this scenario does arise, you can begin to allocate that, is really important.
I think as well it's important to know how your system works, or the main principles behind it. So I'm not talking about the parameters, but there are certain occasions where things are not working. I'm not trying to say that we can predict the future, but obviously if we see short swings and it goes, you have a long-term system, and you get whipsawed, then okay, maybe it's because the volatility is high right now and it's just whipsawing. So if you kind of understand why your system is working and why it's not, then you're less inclined to just throw it out when it's not working, because there's a certain property that you understand that your system cannot handle, and it's just part of the the main course.
I want to say that it's very important also, and I say this all the time, to do all different things what we do. Of course, it's good to be different, but one from each other. But all this must be based on the trend following philosophy. So we have different system, yes, but it must be different exits or different enters from each other, and all these is based different trend and stop, of course. I think so. But all these different stop loss maybe, but all these must be based on the classical trend following rules, not deviate from this. So if the point is it must be different, but not very different, not very far from trend following. We must remember that we are classical trend following traders all the time.
I wanted to go back to one comment people made earlier about how you trade into positions, or when you're managing a multi-strat, how do you deal with trades that are perhaps in opposite directions? So let's say, for example, one of your systems gives you long SPY, the other one goes short SPY. How do you guys manage your positions? Do you actually go out in the market and trade them and take the impact and the costs and everything? Or do you net out your trades and just keep on paper like the position that you would have had? I'm just very curious to see how you guys handle that.
Look, with me, I run algorithms for all my systems. So it's just a purely systematic, automated process where if one goes long, the other one goes short. So each one is run individually. But when I review the performance or analyze the performance, I'm looking at things from a global portfolio perspective, but they're all managed individually. by algorithms?
I have the same exact thing, or individually. So if the algorithm says go short, then it goes short. But then maybe the other system, will say long. So all individually. But then, obviously, looking at it from a portfolio perspective, like to see what the net effect is. So yeah, that's same thing as Richard.
I have the different approach. I do the second method, I think, which you said, where they net. So I call it my mini dark pool. I have a mini dark pool before I send orders to the market, which will collect all of the orders required for all of my systems and then net them out. And then I account for those orders and where they came from. And then I just submit the net order so I can still keep track of each individual system. And I reduce the cost, I reduce the turnover. And then it's just kind of intuitive what results should have been, because you net at the end, then it's fine. But I want to go quickly back to what Jeffrey said, understanding what is driving your strategy. And I do find that in trend following, this is a bit weak. The narrative, and I'll talk about narrative as a mental model, and talk about narrative and the aspect of communicating with non-systematic or even non-trend following traders. I find narrative as a mental model really important, because when I'm trying to create a trading strategy, I'm trying to exploit something. And the reason that occurs helps me figure out if something is broken or I'm doing something right. And that especially is important during drawdown, but that thing still exists. So I could test if that thing still exists. I think a good example would be any kind of risk premia. You could think like shortfall. You could think equity risk premia. You could think of duration risk premia. All of these things are very well known. You can measure them. There's very classical ways out there to see, is this thing exist? Am I trying to exploit it? Is my strategy exploiting it well enough? And then I can understand why. I think a lot of market makers out there, a lot of flow traders are very intuitive as to why certain things are happening. Mostly they bring it back to the actors in the market. So if you're thinking about option strategies, why the put skew exists, right? We know that people are willing to pay for insurance in the equity market. There's a logical reason why. They have a not necessarily an economic reason in the system that we're discussing, and I'll talk about that as the options market itself. They're willing to pay a higher price because they want the insurance, but their economic benefit comes from something else, and that will be managing some other portfolio of equities. And so they're willing to pay up for that. I don't find in trend following we have a unified story that we can tell why trends will continue to occur, why they occur in the first place, how they've done this, and then we have a couple examples like behavioral economics, complex adaptive systems, and all that. But trend following is a bit different. And going back to the mental model part, if you have that, you can tell yourself, or you can be on you have a tripwire, a mental wire that will say, okay, I'm looking at these trades, I'm looking at these markets, or I'm doing some research, and you say, actually, it's getting weaker. That doesn't mean it won't get stronger in the future, but then you start to have a better intuition about your systems, and understanding your systems should be an extension of you. So you need to create some analysis that allows you to understand the cause and effect of your system. Or, I mean, it's a bit strong, but I think you get what I mean.
I think narrative is very important in a few aspects, and if we are talking to the clients, they must understand how our approach works. And I have said many times, I think the best, one of the best, or maybe the best I have heard, it's Richard's narrative: +1 -1 +1 +1 +20. It's perfect. But I think it shows in one sentence how trend following works for the person which even don't understand anything in finance. So it's maybe genius even. I admire it. So, and of course the role of narrative, that in all sales, in all business, that clients must understand how their problems will be solved. And so they understand how trend following works, understand how they will have more money than they have today, and how this money are protected. So I think this is the role of the narrative.
I think, and if I understand it correctly, sorry, I'm multitasking as well, but um, see, with the trend following, what I noticed when it comes to the narrative, there's no real sexy explanation as to why something's happening in terms of a fundamental perspective. So obviously, like let me just give an example. Okay, Tesla price is going up. We don't really care if Elon Musk basically sent a tweet or not, or if that's the reason. We don't look at that. So that's not something that we can basically point out to potential investors saying, "Hey, we look at this and that." The main thing that we're looking at is price. And if you think about price is more a mathematical explanation, or let me say it like that. When we look at it, it's a more mathematical reason behind it. There's nothing sexy about it. Talking about price going up and down, there's nothing special about it. So when we're talking about the narrative, then you're kind of limited to kind of explain it in such a way that it gets people's emotions up. And when it comes to people get attached to things when emotions get involved, and people are less. Well, I don't want to overgeneralize, but a lot of people would not be too interested, or the mainstream are not too interested in the mathematics. They want a nice story. So I think when you say weak, I could agree, because in the sense of we don't look at a lot of things. It's just the price, and there's not much more to say about that.
Yeah, I think the reasons for trend following, the current swathe of reasons are pretty loose and pretty weak. But I do believe that agent-based modeling techniques, computational system programming, computational processes, that ultimately will lead to a better story for trend following. But these feedbacks, we know there are these feedbacks occurring. Are they really behavioral at all times? Well, not necessarily. What determines the decisions of a participant? How much is their own sort of volition versus how much is assigned to their neighbour's behaviour? All of these things. I think it's reflective of this complexity that's found in complex adaptive systems. These sort of the rules-based processes, sort of that under a collective form, sort of result in trending behaviour. But I think it's complex. I think we're on the cusp of getting it. I think institutions like Santa Fe Institute, these sort of cross discipline, multi collaboration sort of physics groups and maths groups and people like that, they will come to a better conclusion for trend following. But at the moment, I think it is a bit weak.
I think that taking from the main street or the client's perspective is really important. Something I have been experimenting with is actually backing out the macro narrative from what the system sees, and saying, like, the system could imply that you're going after X thing, which can tie it into a narrative that they've heard. Um, it helps because I do find that discretionary managers are overly allocated to, at least in my little world, uh, because of the ability to tell stories, and they're able to convince a client to stick with them longer through a drawdown because they understand that narrative, and that's bad for business, for the systematic side. And even when we look at other systematic traders, we judge them for their performance during certain things, and then we assume it's because they had X system or Y mix of things, so they've deviated from their style. Um, while I find discretionary managers can get in a room and they could probably talk for 2 or 3 hours about this big macro picture, which ends up being nothing. Like they probably cannot tell what's the geopolitical risk of XYZ event, 3 to 6 months from now, much less 5 years from now. But I think that the Mike, I'm sorry, I can't pronounce his last name, but on Top Traders Unplugged, has been quite good at addressing that, because I do find that kind of every day, um, when dealing with clients. And to the other side of things, how do we as a group of systematic traders increase our tool set of communication? I mean, both of us are probably more mathy than the average guy on the street, to be fair. you know It's not like we're the great storytellers who are able to read the news and come up with some narrative of what these 5 news articles said to, or listen to some conference call or something. So I find that like it's almost like we're playing their game. We end up playing their game, and I'm not sure that's right. So I'm really looking forward to more of those episodes from top traders, if they come out for more of those studies.
Yes, I think that, of course, discretionary guys talk a lot. They talk very much. You're right. They can for hours. They will talk about the prediction of the future, how they predict the markets. Talk a lot of different things that maybe most people don't understand. And I think math is more for intuition for the person is much more understandable than this macroeconomic things, and in fact it gives nothing. So a person talks 2 hours about what will be in the future, but if he is a so good predictor, maybe extrasensory guy, why he is not so rich as he could be. And I think if we are talking about math, if a person understands +1 -1 +20, this is our methodology, and I think it's even better maybe. But we must talk it in an interesting way, like a lot of traders can. Richard, Jerry, Niels, Moit, so interesting to the people. It's very interesting if you think about this, and that macro guys, they talk a lot, but there is no much sense in it because they can lose. Their money are not protected. They are protected only in their fantasies, maybe, in the most way. And we can tell the people why our money protected, because we have a diversification, because we have risk management rules, and they have a prediction based on maybe nothing, and concentration bets, and they can lose all their money if or maybe not all, but very huge losses they will have in this way of trading. And so I think Van Fowen can tell a lot of interesting things to the people.
Yeah, look, I agree, Oleg. Maths is only a tool, and if the assumptions of that mathematical tool are not correct, it leads you astray. So, I think the maths in finance is a different kettle of fish to the maths in physics, because at least the maths in physics can predict, the launch of a space shuttle and its trajectory and where it lands or the rocket lands on the moon. It's useful because it can actually predict a future path with a degree of certainty. But where the maths in finance sort of comes undone is that it is very incredibly difficult because of the non-stationary nature of the market to predict what's happening, tomorrow, let alone, a few years away. So I personally think that if we rely too much on these tools or these mathematical tools in our narrative, I personally think we're doing a disservice to the investor. And I think that there are better examples, for instance, that we could use to explain trend following by looking at the historical record, looking at the behavior of herds of beasts, looking at the behavior of sort of analogous complex systems, to basically describe the validity of our method. I don't necessarily think that maths is going to be the way that we can explain narrative in a convincing manner. And I unfortunately think investors are under this faulty premise that maths implies that these people know what they're doing.
Yeah, I agree. There's different ways to look at it, of course. I mean, in that example of the rocket, if somebody would explain to me how the fuel was inserted and basically how they calculated how much fuel that rocket needed, I would almost fall asleep. Um, and that's just me saying in a way, like it obviously depends on who the person is. Every other person, some people are interested in that, but I think in the mainstream, people just want to know, okay, there was fuel used and there was a lot of power that came that was basically pushing the rocket forward, and that's how we got to the moon. Just a simplified version. So I definitely agree that maths is a tool to actually get to your results, but to explain it, we might need to simplify it, and maybe, as you mentioned, focus on other things that they might find more interesting. That's if you obviously seeking for investors. At the same time, I think it also depends on who you're looking for. Obviously, if you're looking for more dedicated people that are really interested in what you're doing, then obviously the way you translate that into your sales pitch almost is different than if you want to capture everyone. And I don't think maybe catching everyone should be a target per se, but that just depends on the person or the business.
I want to say that, of course, math is a very universal tool in our in all our world, and but I remember when I was at school, and the teacher of physics said, "Do you know the proverb?" And we knew this proverb because it was written in our class, that the math is a queen of all sciences. We said, "Oh yes, we know it's written in our class," and the teacher said, "Yes, the math is a queen of all sciences, but it's a servant of physics." So math is a tool that will help us to understand in a maximum, I think, or close to maximum simple way how our system works. But if we will talk in a math manner, and if a person, our client, is not a scientist, maybe it's not the best approach. But like Richard said, and I told this a lot of time, and I will tell this a lot of time, +1 minus 1 +1 minus 1 +20. It's very simple math. We don't use different complex formulas or something like this to look at these formulas. Transform is perfect according to this, understand it. Not many people will understand this. But if we use in a simple way, universal math, it's very perfect.
Of course, I want to take this idea to the limit because I always find that looking at the boundary conditions helps. So if this math is dangerous in financial markets, why use it at all? And I cannot justify that. I mean, my entire career would be out the window if that was the case. But I want to open the floor to that because um, it's a possibility, right? It's a possibility if everything is as complex as we stay, it's intractable. There's nothing you can do. Um, then then how do you approach things?
Look, I personally think inevitably it is mathematical, but the use of maths, how we are using it, might be the incorrect form. For instance, can we really explain mathematical properties when we use terms such as infinite? Can we explain things when we use terms such as random? What happens if we find that the mathematics that accompanies that is for an alternative universe that has no practical application in the universe that we're actually existing in? Maybe it's a form of computational mathematics as opposed to more abstract mathematics. Maybe there is no perfect circle. Maybe there is no pi with an infinite recurring numbers associated with the series. Maybe it is finite. Maybe it is discrete. Maybe it is computational. So there might be a branch of mathematics that is applicable to what this ultimate reality is of this complex adaptive system we call the financial markets. But I think that inevitably the assumptions used in mathematical models, for instance, we've gone through 30 years of assuming the efficient markets hypothesis is the dominant paradigm associated with how we should view these markets. That clearly is not the case. There is something non-efficient about these markets. Yes, they might be efficient much of the time, but that therefore devised this sort of mathematical program, which was a bit like Newton's Principia, where we had this clockwork universe all associated with the notion that things operate around a stable equilibrium and everything's going to mean revert over the course of time. The law of diminishing marginal returns sort of slipped into the terms that people frequently used with finance. It was present in our discounted cash flows, modern portfolio theories. All of this fabric associated with this incorrect assumption was built into these models, which therefore made finance almost gibberish as far as its practical application to the real world we live in. So I think there is a mathematics associated with this this thing we call the financial markets, but it could be fractal. It could be, it's a different form of mathematics that people assume using, normal distributions, all of these things that are common within the lingo.
Yeah, what Richard says makes a lot of sense. Before we even get there, I think we have tools that help us, not reaching the boundary that Derek was speaking about before. And these tools are, for lack of better words, computers that help us moving away from very rigid models and equations into more experimental things. What do I mean by that? Well, we all went to school when certain things, certainly in finance, were very prescriptive and very deterministic. You had integrals, and then if you can solve the integrals, you would simulate, but you had a very strict framework. Now we discovered that a particular branch of statistics, which was relegated to the end of statistical books, which is Bayesian methods, now are in vogue, are in fashion. Why? Well, because we can waste a lot of computational cycles doing all sorts of things, and of course, we get Derek's seal of approval for MCMC, but all these inference-based methods are really important in finance. Not so much to discover new things. I think human nature is never going to change. We're always going to oscillate from extreme giddiness to depression and anything in between. But how we do that, what are the nonlinearities, the discontinuities around those different phases and stages of the market. So we have tools. I'm sure that some of us, I am, but I'm not the only one, are using them extensively, and I think this helps. Shrugging our shoulders and say, well, the world is definitely not distributed as a normal as we were told, but who cares? That's just a prayer. I'm going to start there and see where I can iteratively get to. And this is very important because you completely reverse the flow of reasoning from deductive to inductive. And I think that's a major, major advance, much in the same way as this ergodic economics and stuff like that. But I think, being able to infer and, proceed and go from, particular instances of this reality, this simulation that we call reality, to a more general principles is really very powerful, and you can do that with inferential statistics.
Yes, I like general principles very much because it shows me the power of transforming. And I said many times that I see transforming principles in a lot of different things. And for example, a weather chart. And I have told this that in my region, for example, in April, we have from 20 to 12 degrees maybe from a range of a temperature, and 7 Celsius by Celsius 7:12, or maybe 6:13, 6:15, and after that in May it goes to 30 degrees. So the same transforming principles we see this, and maybe almost all the charts look like this. Not all, but almost all the charts, most of the charts, I think. So this general principles, it reminds me that transforming is very serious thing. And if we are talking with investors, I think it's maybe another topic. We must, and we talked about this, we discussed this, we must talk with them in their language. They must understand us in a simple way, and it must be exciting for investors. Maybe this is the role of narrative that must be interesting. How transform works, what will be, why it works, what will be with transform. I think it's very interesting things. And if we are talking about global macro, which investors don't understand, and I don't understand it myself, and maybe about math in a very complex way. Also, if somebody will tell me in a math, maybe a professor of math will tell me why trend following works in his language, I don't know exactly. Will I understand this or not? I don't know. So
I think everybody makes assumptions, and in general, we need to make assumptions or have a foundation of assumptions to even move forward. And I don't know if I'm skipping over, what we're talking about right now, but if there were no general basic assumptions, we wouldn't have cars, we wouldn't have houses, right? So there are some general assumptions that we make. Now it's then um, things that you build on. So we have these tools that we can use to obviously see which IDs that we have in our head that works doesn't work. That doesn't mean that these tools are perfect, and these tools might be incorrect, fully incorrect. But we need to use the tools that we have right now until proven otherwise. And I think that's why it's important that we have these discussions so that we can, um, have these IDs, share these IDs, and kind of make our own decisions based on it. The same way someone else will say discretionary trading is better than trend following or mean reversion. Everybody has their own assumptions. So I think what becomes problematic is when you have too many assumptions where you're not open-minded, like you're so close-minded that you cannot explore other items. That's when there's an issue. But um, yeah, I think there's a foundation of assumption that we make. We have tools that we can use to test it. It doesn't mean it's perfect, but we need to start somewhere, right? Same way someone started somewhere with these primary planes, and now we have bigger planes, to build on. That doesn't mean a plane or a car is the best way to move from A to B, but that's what we have right now. And maybe in the future we have flying planes, but that's based on our main principle foundation that we had previously. So yeah.
uh, for me, trend following is the best approach because at least, as Neil said many times, and I very appreciate this, that there is no such evidence of success in any other systems. There are no maybe there are no artificial intelligence funds or discretionary funds that exists more than 40 years or more than 50 years. And trend following funds, we can see this, it's Down Capital and some other funds. They exist, they survive, and they're in profit. So we have as much evidence as we see, maximum evidence, it's for trend following strategies. We don't have much time because artificial intelligence is only a few years is used. We don't have an evidence that it will survive after the crisis, after the big crisis. And I'm not sure that it will survive, but I'm sure that trend following is the best approach.
I will address Jeffrey and Oleg's comment. For Oleg, I think that we do have a good example of what I would consider a discretionary trader who has a 40 years track record, and that would be Warren Buffett. I'm not a Buffett fanboy or anything like that, but he has applied the same consistent system throughout time to compound his returns massively. It's not a fund necessarily, his structure is different, but the idea is the same, that there's a sustainable edge in what he does. Going to Jeffrey's point in this whole idea of assumptions, I actually think there's alpha in this. There's alpha in the understanding of the assumption and working with the tools that you have and understanding those tools' pros and cons. The reason I say this is because there's a lot of people who will just apply the things and not understand what assumption is taken. If you have a better idea of what assumption is taken and can counteract that, um, then you have a better chance. And the example I will use is the Black Scholes in option pricing. We
Um,
still use it. We know it's wrong, but we know how it's wrong. We know where it's wrong. We can adjust on that. And if you know that it's wrong and how it's wrong, it's better than trying to create something new. Okay, I'm not going to win any Nobel Prizes for making another option strategy. But that gives you something to build on, and at least you know the pitfalls, the foibles of this type of approach. But from the other side, if you are limited in the tools that you have, you can also adjust what you're placing in it. Um, Transforming your system makes things more normal. The synthetic assets can be applied to a transform that makes the results more normal, especially with a continuous signal approach. That's one of the benefits. So you cannot necessarily create normal financial markets. But if you apply a profitable system to it, you may be able to transform that synthetic assets return into something that is more normal. It's not perfectly normal, but more normal, or has a statistical property that you're looking for, positively skewed, or maybe you're looking for something that has a high win rate, whatever. But you understand the principle that you're using in the tool, and you framed the problem and the data or whatever you're doing to fit inside that constraint box. And if you're just, a lot of people with this ML thing, especially with the proliferation of Python, or I even was interviewing a guy for my team, and this guy came in with all these backtests. He's been working on all this stuff, and I'm like, but you just threw things with a Python at the wall. Um, there is no taking in for the assumptions of that kind of stuff, and not understanding exactly in detail why certain things are. Um, I will go to like the a Bruce Lee quote. It's like, I'm not afraid of the man who knows 10,000 kicks. I'm afraid of the man who has done one kick 10,000 times. If you really clearly understand the limitations of that tool, you are able to adjust over those 10,000 repetitions or whatever. I mean, and be able to apply that to a world where it doesn't exactly fit, or you're able to do something better, pre-processing your data or alter what you're feeding it such that those assumptions don't necessarily break down.
Yeah, look, I agree with that, Derek. And I honestly think that's what we do with trend following. So we might not know exactly why trend following works, but we certainly know historically through the distributions, through the nature of the distributions, what we want to avoid. So that therefore gives us a framework to define constraint boundaries within which we don't want to participate. And therefore, we're left with a domain that lies outside that framework of normality that we believe doesn't give us that necessary edge. So and effectively through that process, we are transforming our result from the noise and mean reversion that exists in the market distribution that we know exists, but we do know that there are these tail regions, the leptocotic nature of these distributions. We know there are particular aspects of that distribution we can target, and therefore we transform our trade results from extracting that edge from the tail of the distribution of returns. So we need to know what we're targeting to therefore generate these equity curves with positive skew, all of the features we like, which deliver these compounding benefits.
Yeah, I think that reframing the problem of assumptions and reframing the issue of math and using these modern tools is really where people have made a lot of progress. I don't necessarily think that it's an excuse anymore to say that the markets are not normal, you cannot predict. I mean, I've said many times in the Clubhouse, I am definitely a predictor. I'm someone who's building models that have uh, the predicted expectation of positive returns in the future, and that I believe that there is a positive expected value more than a positive, a negative expected value in the future if I take this action. And I think this is where I get to the borderline of machine learning, right? I will say that I'm a fan of MCMC, which has already been brought up, and inferential mathematics using Bayesian techniques. That is definitely something I use in my systems in order to bring about this dynamic nature. Is this kind of Bayesian optimization that allows it to like learn, but like learn not with ML. I guess. I mean, maybe you could consider it an ML, but the idea that you can remove certain things and transform some things, that combination compounds each other to make the tools that are available to pretty much everybody much more applicable, and to understand more because you can push the boundaries of these assumptions of certain well-defined things like modern portfolio theory or options pricing or however, and be able to turn it into something that is broadly applicable to the real markets. And having that first principles idea, I hate keep saying this, but like if you have you understand the principle behind which these assumptions are built, and you have the understanding of what this thing is actually calculating, you I mean, then you can very clearly attack these assumptions and transform your data in such a way that it can better fit. I won't say it's a perfect fit, but better fit those things, as opposed to just throwing things on the wall and do a data mining based technique. And I do believe that in this area of financial mathematics is where I think machine learning will kick off. I don't think it's going to be able to predict T+1 returns or returns in the next year or the outcome of certain elections. We've seen how that has gone in the past. But I do think it can help remove statistical assumptions that we place on the well-known formula.
Yeah, is the whole epistemic versus aleatoric uncertainty, and how meaning the uncertainty you have around your model or your abstraction, the epistemic, versus aleatoric, which is the uncertainty inherent in the phenomenon, i.e. the market in our case that you're tracking. In other words, all the sort of sum of individual utilities which produce something else, which may or may not be. Richard was talking about rogue waves and things like that, may or may not offset each other. So you have convergent and divergent behaviors happening. So this would be down to the aleatoric and dynamics of markets, but also with modern tools you can track your epistemic, i.e. the limitation of your models, and this is definitely nothing to do with machine learning. And I agree with you that certain methods can do learning away from machine learning, and Bayesian certainly is the method of choice as far as I'm concerned.
All right, guys. Ladies and gents, I think that we're coming up on 2 hours now, so I think it's time to wrap up. Thank you, everyone, for coming, and I will post a poll, which was a great idea, for the next topics. Please feel free to DM me on Twitter with any ideas. Bruno P has been doing a great job of submitting new ideas, and then I will post that up over the weekend so we can make sure that every topic that we discuss here in this clubhouse is broadly appreciated.
Many thanks, guys. See you all later.
Thank you.
Yeah. Thanks, everyone.